Good morning, everybody. Kyle Custer, your senior analyst at Seafried and Brew here, and had a busy weekend helping some friends move into new houses that they had recently purchased, and I thought it was a great time to talk about a couple indicators that had come out in the past weekend as well as today. So first off, we have housing starts, and what we're really seeing right now is a little bit of a leveling off, but as with every single indicator we're going to go over today, they've all come out above expectation, which is obviously a good thing and will likely affect future FOMC decision in terms of moving rates up probably towards the end of the fall, maybe December. That's been coming out recently that the chance of the rate hike has significantly increased as the Brexit has not had the detrimental effects that were anticipated. And indicators such as the housing market have actually been improving quite a bit. Now, of course, is that tied to interest rates? Probably, being so low. We'll get to that in a second. New home sales, a more impressive release, came well above expectation at an annualized rate. It was anticipated to be around 560,000 new home sales. However, just today it came out at 592, so much higher. Market reacted a little bit to it, but what's also important to look at here is the 2007 levels. We're all at the 2007 level right now. We really have just begun to recover from the recession where we were down at this basin here. And you can look at the slope here. The last couple of years has just been virtually nothing. We've seen a nice pickup in new home sales, but what about existing home sales? Existing home sales looks volatile. However, let's just smooth this line out right here. This was definitely because of the stimulus that was offered for first-time home buyers, and that was around 2009. I participated in the one where you have to pay it back. A few months later, unfortunately, they offered one where you no longer have to pay it back, and that times perfectly like this, but also proves that the housing market simply just moves its purchases forward. Immediately, the year following, there's a significant drop in existing home sales. That obviously was a result of the big influx of buyers in the beginning. So just move their purchase up. Now, the question is, are people moving their purchases up because of interest rates? And you could say yes, a little bit. The slope is not very significant here. The last release that we received last week did show a nice increase, but what we're really wondering is what's going to happen when mortgage rates really get back to where they were in 2007 again, at around 6%. We're currently at that same level, but we're floating around that mid to high 3% rate for mortgages. So that may not be enough to get people to enter the housing market. What really is, aside from a short-term benefit from a stimulus. So if rates really do shoot up on the long end, the housing market is going to be hit pretty hard. Indicators definitely to watch, of course. That's why we're here. We're always trying to keep an eye on all these for you. So just something to keep an eye on. Thank you very much. Have a great week.